Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Allegiant stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a small cap company, 777 million market cap. They're trading at $42 a share and they have 18 million shares outstanding. Allegiant is a leisure travel company that provides travel services and products to residents of underserved cities in the US. The company offers scheduled air transportation on limited frequency, offering exclusively nonstop flights. It operates a fleet of 126 Airbus A320 aircraft. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have positive free cash flow in 2021, 300 million, but then negative after that. The negative is pretty consistent in the low $100 million a year. Net income is the profit or loss on the income statement. It's revenue minus expenses. That looks a little better. It's positive in 21, 22, and 23. Negative 14 million in the trailing 12 months. So this implies they're investing into CapEx since their net income is a good amount better than their free cash flow. Revenue is a sales for the company, and that went up 35% from 21 to 22, 2.3 billion, up 9% into 2023, 2.5 billion, then flat into the trailing 12 months. They do pay a hefty dividend, 5.75%, which cost them $45 million. Since they have negative free cash flow, they have to fund the dividend with debt or equity. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 3.2 billion. We discounted those numbers back to today using weighted average cost of capital. We get a value of the company of $820 million. We divide that by 18 million shares. And we get a calculated stock price of $45. They're trading at $42, so they're trading at a 5% discount. It's a buy according to the model. Do you think it's a buy or sell? Let me know in the comments. It looks like the website Simply Wall Street does not value this stock. However, 10 analysts priced this stock at 55. They say it's undervalued. There are 16 companies in the same industry as Allegiant, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend a little more than the median in CapEx, 439 million. Most of their CapEx spend is the purchase of aircraft. Debt to equity ratio is better than the median average. For every dollar of equity, they have $1.70 of debt. They pay the highest dividend. They're only one of the 3 companies that does pay a dividend. Negative free cash flow, so they probably shouldn't be paying a dividend. They rank 11th in market cap, 777 million. A really good price to book. Investors are paying 40 cents for $1 book value. We can't look at their PE or price of free cash flow. Price of sales is equal to the median. This means investors are paying 30 cents for $1 revenue. They generate 2.5 billion of revenue, which is lower than the median, and they're still growing. Their 5-year annual revenue growth rate is 7%, which is almost double the median average. Here's their latest income statement, the second quarter of 24 compared to the second quarter of 23. Passenger revenue is down quite a bit. It was 643 million, now it's 594 million. All their other revenue segments are up from last year. Resort and other is up a lot. It was only 400,000, now it's 17 million. Their biggest expense is payroll, 209 million, then fuel, 170 million, both up from last year. Total expenses, 630 million. Operating income is down. It was 133 million, now it's 35 million. Lots of companies are getting squeezed. Revenue is not really going up. Sometimes it's going down, but expenses are still going up. They spent 40 million of interest on their debt, a little more than last year. Pre-tax income 18 million, 4 million of taxes. So net income 14 million, down from 88 million. EPS 480, now it's 75 cents. And they're adding shares. They have to fund that dividend payment. Last year 17.7 million shares outstanding, now 17.8 million. And they did not pay a dividend last year, now they're paying a dividend. But I would not be shocked if they cut their dividend back down to 0. To summarize, I have them trading at a 5% discount. I give them a ranking of 4 out of 10. There's something appealing about this company. I can't put my finger on it. Would I buy them? 1 out of 10. I guess it's not that appealing. Ratio is 3 out of 10. A good price to book and price sales. Financials 3 out of 10 because their revenue is up 46% from 2021. It's up a little bit from 2022, but down slightly from 2023. They do have negative free cash flow. But they did generate a healthy amount of free cash flow in 2021, and they pay a massive dividend, 5.8%. If you own the stock now and it goes up a lot and they raise that dividend to be more in line with the current yield, then your yield will be like 10-15%. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.